Hi, and welcome to Retirement Financial Planning with Steve Schneider. Steve, how we doing today?
Oh, we're doing great. Thanks to having me, Mark.
Awesome. Listen, we have a huge topic today, and this is kind of a sneaky topic.
Yep.
Okay, we're talking about risk management. And correct me if I'm wrong here, but I think there are a lot of people out there who don't understand the risk that they have with all of their money, their portfolio, their savings. They think that they might be in conservative investments, or that if there is another correction in the marketplace, it won't be like it was in 2008 or 2002, because they've changed things around moderately, but they might be in the same place. Do you see this, that people might not understand when they come in and see you the amount of risk they have in their portfolio?
Right. Yeah, Mark, you hit it right on the head that the risks in your portfolio sometimes are hidden and people don't realize it, especially if they just keep treating their portfolio the same as they did when they were collecting or saving for retirement. And that specifically we know two things change in retirement. One, your investments that you say you want to be more conservative, but you got to be careful because you still got to be able to invest in a way that overcomes inflation, as we all know is real. And the second thing is your money has to last a long period of time, and you quite often are not really prepared to take big downturns in your portfolio. So yeah, retirement financial planning requires you to manage risk differently than you do as you were saving money.
So how does someone get a reasonable rate of return in this interest environment that we have right now, and potentially reduce risk? Again, because I think a lot of pre-retirees and retirees don't understand the amount of risk they potentially have in their retirement.
Right. Yeah, no, exactly right, Mark. So one of the biggest objectives we look for in retirement is to reduce the volatility in a lot of our investments that we used to be able to weather through when we were saving for retirement. But once you're in retirement, we reduce the volatility, and then we look for conservative investments that still get you a good rate of return and returns that are in excess of inflation. And thankfully today we have quite a few products that can do that.
So are those products correlated to the market, or do they operate independently from the market?
Yeah, we have a combination of both. Sometimes they're correlated to the market, but we protect on the downside of the market. And other ones that are more focused on fixed type returns for the longer run. And the combination of those two gives you the best result in retirement.
So I like to bring up this word, Steve, because in mitigating risk, which is, as you know, very important for retirees, one knowing your risk, but then mitigating it, how important is the concept of principal preservation now in retirement?
Yeah, that's key. We do not want to be taking risks with our principal in retirement. We always say there's no reset button on retirement. It's not like if you take risk and you end up, eroding your principal, that you're going to go back to work or rebuild your portfolio. We want to find a way to actually shield you from that downside risk. And the class of principal protected investments do a really good job of that.
So, in a previous show, we talked about the 4% rule, and it's probably not great anymore. And I remember it might have been a year and a half ago that the Wall Street Journal was talking about the 4% rule.
Right.
Is really more like the 1.9% rule right now if you want that money to last. What would you tell those folks that, hey, we have to make this money last, we have to mitigate that risk? What are really, we kind of touched on the strategies, but maybe we can get a little more granular as to what those strategies are.
Yeah, well, just to go back and address that 4% rule, what that 4% rule really tells you is that an analyst has gone back and looked at historical volatility and historical trends in the marketplace, and based on that, you shouldn't take more than 4% of your portfolio value out every year. And we get really concerned about that in retirement because that 4% rule was 6% many years ago. It changed to 4%, and like you said, it looks like it's going to drop again because what we're concerned about is volatility may be a little bit higher now or in the future than it was in the past. And so again, this is where the principal protected and specific investments we have that are derived for taking income out can achieve much higher rates of return or withdrawal rates out of a fixed amount of a portfolio without you taking the risk. And so that's what we really look for, and a lot of the planning that we do uses those type products.
It sounds to me like you're saying that the income that I pay myself or my spouse, my family, through retirement should come from a fixed non-risk account rather than liquidating funds from an account that can fluctuate. Am I making a fair statement here?
You are absolutely correct.
Take a minute and talk about that.
Yeah, so you're absolutely correct. In the modern way we do financial planning, not the old way like a 4% rule or the 60-40 rule or anything like that, we use what's called the asset allocation strategy, and we allocate a certain amount of money out of your portfolio for income, and we make sure that we don't take any downside risks, that we have very high rates of return so far as withdrawal rates, and we optimize that investment for income and especially guaranteed lifetime income. And then that enables us to take other portions of our portfolio and let that grow and achieve other rates of return. And the combination of those two is what really spells success in retirement, and that's what we focus on.
Steve, thanks so much. If you want more information about understanding the risk you have in your portfolio and potentially mitigating that risk, hey, pick up the phone right now and give us a call in the office or go to our website.